I've been wanting to invest in the midstream energy sector for quite a long time. Take a look at the distribution history for MPLX. Constantly increasing distributions, or EPD. That's one of the best distribution charts I've ever seen. The first challenge, though, was that many of these midstreams issue K1 forms, and that can delay your tax filing. But a midstream fund can fix that. The bigger red flag for me was that midstreams were radioactive 10 years ago, then flipped around to deliver spectacular performance for the past 5 years, a very dramatic turn. Today we'll look at why I've changed my mind on this sector and the 3 funds that I'm focused on. We'll start with a quick walkthrough of what makes the midstream sector interesting to an income investor, then explain how they make money. We'll look at why they performed so poorly from 2014 to 2020 and why they went on to crush most other sectors after 2020. Finally, I'll show you the 3 funds I'm eyeing for investment. Midstreams are set up for income more than growth. Many of them are structured as master limited partnerships, or MLPs, because the IRS provides these with an exemption from corporate tax for income generated in the energy sector. Those partnerships are structured so that the general partner distributes 100% of the available cash rather than retaining it for growth. The second thing I like about midstreams is they're not highly correlated to the stock market. A good example is the 2-year period beginning in 2022. AMLP is a $10 billion fund based on the Alerian MLP Infrastructure Index, which makes it a good benchmark for the midstream sector. This shows us that it's possible for the S&P 500 to decline while midstreams are rising in value. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth. And this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%. And if you'd like a copy of my portfolio, it's available via Armchair Insider. Link in the description, it's free. Number 3 reason midstreams are enticing is the demand that AI is placing on power generation. The global demand for data center electricity is projected to double in the next 5 years. Currently, natural gas is the number 1 supplier of power to US data centers. Looking to the future, coal is on the decline, gas and renewables are projected to grow. Needless to say, an increased volume of natural gas would be good for midstreams. Last of all, midstream operators are part of the energy sector, so why not just buy the biggest companies in the energy sector? Companies like ExxonMobil and Chevron, they pay dividends and they've delivered excellent returns over the past 5 years. I'm using XLE here to represent the energy sector, and it's heavily weighted to Exxon and Chevron. The yields for those 2 oil companies are 3.5% and 4.5%, higher than most S&P 500 stocks, but significantly less than the 7 to 9% you can get from midstream funds. Generally, those big oil companies are better for growth or dividend growth investors, and midstreams are better for income investors. In their natural form, fossil fuels, whether oil or gas, are found underground. There are operators like ExxonMobil, Chevron, Shell, and BP that find it, extract it from the ground, and those are upstream operations. Many of those companies also have downstream operations that turn the raw components into usable energy like gasoline. Downstream is the most visible part of the energy sector because we see their brands in the form of gas stations. Midstream is the boring part that happens between upstream and downstream. Specifically, it involves the processing, transporting, and storing of the oil or gas. Some of the transportation occurs across vast networks of pipelines, so the word pipelines is often used when talking about midstreams. Another way to think of midstreams is as a toll road. It's a bit like owning a highway where you get paid tolls from every car that passes through, whether the price of gasoline goes up or down. So how does all this turn into cash dividends? Well, the midstream companies charge fees to use those expensive pipelines and processing plants. The fees are mostly based on volume, not the price of oil or gas. Also, the fees are set forth in long-term contracts lasting years and often containing minimum volume or storage commitments so they don't bounce up and down constantly like the price of oil does. Of course, wild swings in price will affect the demand for energy and eventually affect the volume, but generally, midstreams are less volatile than the big upstream companies like ExxonMobil and Chevron. If we look at total returns for the energy sector versus midstreams, we can see that midstreams are less volatile. Or to put it another way, the midstream returns shown in orange look like a straighter line than the big energy companies shown with the blue line. The midstream sector is a tale of two periods. 2014 to 2020 was the worst of times, and 2020 to 2025 has been the best of times. During the first period, the energy sector was hit with two major shocks. The first shock was the OPEC Thanksgiving Day surprise. They switched the turkey for an oversized chicken. That wasn't the surprise. Some background. These OPEC countries had heavily influenced oil prices for decades, and then around 2008, the North American shale industry gradually began to threaten OPEC's dominance. Shale was a new way to extract energy resources. Here's an example. Conventional gas production involves drilling a hole straight down, as you would imagine. The North American shale industry drilled much deeper and into solid rock, then turned sideways with horizontal drilling. They also pumped water and sand into the hole at high pressure to fracture the rock and release gas, also known as fracking. In 2014, North American shale production had increased to the point where energy resources were oversupplied. The expectation was that OPEC would cut production of their oil to prevent a fall in prices. Instead, OPEC decided, on Thanksgiving Day 2014, not to cut production, but instead to enter a price war with the shale industry. Energy prices collapsed. Upstream energy companies cut back production dramatically, which in turn hurt midstream operators. Having volume contracts works well under normal circumstances, but not if your customers might declare bankruptcy. Shock number two requires far less explanation. It was the 2020 pandemic. We all know that planes stopped flying and vehicle use dropped dramatically. The demand for oil collapsed and the price of oil actually dropped below zero for the first time in history. The result of these two shocks occurring in less than a decade was a decline for the energy sector. More specifically for the midstream operators, prices and distributions fell dramatically. The total return for 2015 to 2020 was a sickening 51% loss over 6 years. The price of the funds fell, but so did the distributions. We can see a pattern of substantial cuts over a multi-year period. After the 2020 pandemic, it's a different story. The midstream sector has done very well, and there are some midstream funds that outperformed AMLP, which we'll get to shortly. So what changed? The obvious answer is no market shocks on the scale of the two that I just explained. The less obvious answer is that the midstream sector became more financially conservative, including reducing leverage. The sector reduced average leverage from 4.4 down to 3.8 over just 12 months during 2022. It also shifted its focus from growth to internal cash flows instead of borrowing. I've come to the conclusion that buying individual midstream operators is time-consuming and doesn't give you much diversification. There's also the K1 issue I mentioned earlier. Enter midstream funds, and there are quite a few. So I narrowed it down by looking at factors important to me, like a minimum yield of 7%, a history of at least 5 years, and then sorted by total return over the past 5 years. The top three were EMO, NML, and AMZA. Honorable mention to these funds who performed well over the past 5 years, but not quite as well as those three. Each of these three funds could be their own review video, but to save time, let's quickly scan through the key elements, starting with distributions. Here's EMO. We can see that the last of the good old days were right here at the beginning, and then the pandemic led to the widespread cuts that affected most midstreams. In October 2024, it gets confusing because it looks like a cut, but it was actually an increase. If you check the table, EMO switched from a quarterly payment of 67 cents to a monthly payment of 33 cents. And 33 cents a month equates to 99 cents a quarter, so that was a good thing. NML is much more simple. The giant 2020 cut followed by some increases and then a huge increase. And then finally, AMZA had the COVID cut, was a little bumpy for the remainder of 2020, and then enjoyed several increases. Snowball is handy for distribution charts like this, but I mostly use it to combine my stocks from 3 brokerages into one dashboard. I can rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a free trial and a discount. 2 of the 3 funds are closed-end funds, which means they can trade above or below their net asset value. Both are currently trading at a discount, which is good. ETFs trade at their net asset value, so no discount there. There's some commonality to the top 3 largest holdings. For example, ET is a large holding in all 3 of them. EMO uses the most leverage of the 3, which helps give it a boost during bullish times, as we'll see shortly. EMO also offers the highest yield at just over 9%. For a clearer perspective on the 5-year total return, we'll switch to a chart format, and EMO is clearly the leader. For some context, I'll add the Midstream Index as represented by the $10 billion AMLP fund, and finally, even though they're different asset classes, here's the S&P 500 just for reference. Expense ratios are complicated for these funds because they're required to include deferred taxes and interest, which makes the numbers look absurdly large. For clarity, I've only included the management fees and operating expenses here. EMO's expenses are roughly double the other 2, so that's worth noting. A reminder that all expenses, though, are deducted before the yield is calculated. Tax treatment varies by year, and I've read that non-destructive return of capital is possible with these, which would be nice, but it didn't happen for any of these funds in 2024, at least according to their statements. They all reported all of their ordinary income as qualified dividends. Many individual midstreams issue K1 forms, which adds time and complexity to filling out taxes, and these funds avoid that problem. AMZA is the smallest of the 3, and one thing that I did notice is that the bid-ask spread on that fund can be high. According to the Virtus website, it's averaged around 0.5%. So I suggest checking the spread, and if it's a big spread, using a limit order when buying or selling that one. We don't have time in this introductory look at midstreams to explore the details of each fund, but Alpha Hedge provides a good overview in this article on Seeking Alpha about the top performer, EMO. It covers the differences between MLPs and C corporations and why the operating expenses aren't as high as they first appear. I'll link to that article, which I suggest reading if you're considering buying EMO, and I'll also include a link for a free trial and a discount. I use the premium level of membership. With the exception of holding HESM for a little while, I've ignored this sector because the 10-year return just looked so bad. After looking into it further, I now understand that the midstream sector today is different from the midstream sector of 10 years ago. Now, it could still get pummeled by a war or some other black swan event, but after taking 2 black eyes, it's more resilient than it was back in 2014. Compared to other sectors like finance or technology, energy is quite concentrated, and we all know it can be volatile. So it still comes with risk, but I've come to the conclusion that I do want exposure to it now. Going forward, I'll do deeper research on the 3 funds covered today, and based on that, I plan to start positions on one or more of those, depending on how many are needed to cover the sector reasonably well. As I start building positions, I'll update you via Armchair Insider, which comes out about once a month. Before I go, I mostly make videos about investments I like, but I like some more than others. And if you want to find videos of my favorites, click here for reviews that are focused on my top 10 holdings. That wraps it up for this look at the midstream sector. More Armchair Income coming soon.
Armchair Income.